Welcome to Lightbulb Moments. Join us as we explore transformative experiences and insights in business and life. Here's your host, a maximizer and problem solver who, through his extensive skill set and network, builds long-lasting and meaningful relationships and continuously learns and applies new knowledge, Phil Fornaro.
Hello, everyone. This is Phil Fornaro, and this is Lightbulb Moments. It's all about the energy. I'm really excited today because I get to talk a little bit. It's been like 2 weeks or 2.5 weeks since I've done a podcast. I've been doing like 3 or 4 a week, and for whatever reason in life, I haven't been able to do it. So I'm all full of energy about getting back into this because this gives me life and happiness and joy all in the same breath. So, and thanks to everyone who's listening. We're doing this in late October 30th of 2025, and October was miraculous for our downloads, all the great people that we've talked to. We had a couple spike days, a couple days in the 2,300 people were listening on those days, and just a great month. So we're rocking it, and it's all because these guests keep on getting better and better and better. So, and I thought by this point, which is kind of funny, I thought we were going to be back to the same people we started with on round 2, but those people keep on yelling at me because they want to be back on, and but we got too many interesting people to supplant them. So, and today will be no exception to that. So I think that this is going to be an exciting one for me because it fits in all the things we've been talking about: wealth, generational wealth, how to create wealth, how to build businesses, how to exit into the public and private markets, and how to simply do this. And this is really, really important to me because I have always been the person to say, I want to do this on the back of a napkin. And my world is much smaller than our guest's world, for sure. However, I like the concept, and I think you're going to really like this as well. So pay attention today, Bright Community, because you're going to get a real treat right around Halloween here. And Christopher Volk is going to give his opinions and understanding and his knowledge to you today. He's giving you something that we've never received on this podcast before, how finances work, how to exit, and so forth. So, buckle up, everybody. It's going to be a lot of light bulb moments coming your way. So, Christopher, how are you today?
Bill, I'm awesome, and thank you for having me on the show. It's just great to meet you.
Yeah, so that's funny. Is I think most people, and we didn't get very acquainted at the beginning, but that's sort of my strategy here. I want to get to know you while we're talking here. So hopefully that's okay with you.
Totally. And the reverse is true. So we're going to have a good time.
That's right. So now you're the author of The Value Equation, A Business Guide to Wealth Creation. And to be perfectly honest, it's very interesting. I never read the preface, but this time I did. And I'm so glad I did because guess what? You couldn't have done anything to inspire me more than by quoting Schoolhouse Rock at the very beginning of that preface. Why'd you do that, Christopher?
I was trying to take something that's pretty complicated and it isn't really discussed. It's not taught in school, and it's about how businesses create wealth, but you're trying to map it out for people in a kind of a simple way. And so the math is all middle school math, but there is some math there. But you don't have to be a rocket scientist to understand any of this stuff. And I'm a financial modeler, partly by background, and a finance guy. And so I've always been interested in, like, how do you take a business and distill it down to like the fewest possible moving parts. And so basically what this book does is kind of does that. I mean, so that people can kind of frame in their mind what it takes to create a business that has the chance to create wealth for both them and other stakeholders in the company.
That's great. So before we get on to some of that, what was your favorite Schoolhouse Rock episode?
Constitution.
Yeah. It's between that one for me. Obviously, I'm just a Bill, right? Or is that
only a Bill, right?
Yeah, yeah.
It's only a Bill. Yeah,
yeah. And I love Bill, and but electricity was pretty exciting to me as well. So
yeah. Well, I mean, it was that was such a great show, and it was great because it distilled stuff down into something that was simple, and kids could understand it. But then it's great as a grown up, today to look at it too. I enjoyed it.
Yeah, as I still say, I got through my first history classes because I was the only one to know the preamble. It was great.
Mm-hmm.
So this book, when you decided to write it, so actually, give me a little bit of background upon you. And it's funny, I do want to talk about Store Capital because I got a good connection to that entity, through one of the alternatives I invest in. But but tell me a little bit about how you progressed in time to get to the point where you're going, hey, I got to write a book here?
Yeah, so I've been writing articles my whole career since day one. I just enjoy doing it. And I was a history and French major in college, so I didn't take a single business class. I got an MBA later on, so I kind of redeemed myself, but I was just doing that. And somewhere around 1999, I was writing a book, excuse me, an article, and it was an article on you know the elements of corporate returns, uh, and that started me thinking about how you can look at some companies and what companies are better than other companies and so on. What are the things that make companies great from a financial perspective? And then later on, when I started Store, which Store is a real estate investment trust, which basically is just a real estate company that owns a lot of real estate that's rented to tenants on a long-term basis, and they kind of use Store as a means of financing their real estate instead of borrowing money from a bank. So anyway, when I was there, I did a video series called Store University, and it was basically a whole group of videos on what it takes to create wealth in a business and whatnot, because I thought it would help our customers out and make them think about the companies they're running and why they're financing them in certain ways and what ways they could make them more efficient. And so somebody calls me up one day and says, this could be a book, and I thought, well, okay. And he starts to ask me for what the word count is of all the videos. So I got to find out what the word count is. And it was close enough. And then I basically put that idea on the shelf and didn't do a thing. And then 2020 happened when we're all holed up and we're not traveling. And it's kind of a depressing time to be around. And I thought, well, let's make something good out of this year. So I wrote the book mostly during 2020. And I didn't steal much from the video series. I kind of rewrote it. I mean, there was some stuff that I stole, but basically a video series and a book are different. So the book is a new invention, and then I got Wiley to publish it for me, and it's maybe the only book out there on how businesses create wealth. So I'm happy to have it there, and it's stuff that ought to be taught to business schools, and it should be kind of part of people's core curriculums, but it just hasn't been up until now.
Yeah, so that's good. You went to something which was intriguing. Now, I got to be honest. You've made it simple, but I'm not. I'm sort of mathematically challenged, so to speak. I understand, like I said, back of napkins, and I went through it, but I'm so entrenched in it. I got to page 50, and I wanted to stop. I have to stop in your book, absorb it, because I want to be prepared for it, because it builds on itself. I think every little part of it. You set your summation. You talk about your 6 variables, which I love to talk about, but it's just the complexity of business. But you've done a really nice job of making it that this is applicable to almost all businesses. Was that your intent when you wrote it?
Totally. I mean, it's universal. And I basically started using some of these tools in our own company. So in 1999, I was running my first public company. So I took that company public in 1994, and then we sold that to GE Capital. And then later on, after we sold to GE Capital, I left and we started another company, and ultimately we'd start a third company later on, which was Store Capital. But in starting these companies, when you're trying to raise money from people, it's kind of useful to have a really good business model laid out for them. And oftentimes, financial projections that people give you are really complicated and they're long. And so what I was able to do by taking some of these tools was to kind of net out the financial model for people so they could understand what the components of the model were, and they could have an aha moment, yes, I want to invest with Chris. I want to invest for this team. And so when you're starting a business, one of the important things is that you got to figure out how to raise money for that business, because most of us don't start off with any money at all, right? And we're kind of all going on to Shark Tank or something like that, trying to figure out how to get somebody to help put up money in our business. And you're not going to get people to put up money unless you have a pretty good idea of how you're going to run the business and have a financial model behind it. So this became kind of the basis for doing that. And later on, at Store, by the time I left, our biggest shareholder was Warren Buffett. So we sold 10% of the company to Berkshire, and the financial model that we built to create that company was hugely responsible for attracting investors like him.
So that's really good. I mean, that's our first, or many of light bulb moments, but that's pretty interesting. Is that I find myself when I look as an investor, I look at that pitch deck as the first start. Obviously, I have to do more due diligence after that. But if the model's easy to understand and the financials are clear as to how you're going to use the business model to achieve the financials, then you're going to get to the next step. If I read 300 pitch decks, I'm going to only look at the ones really deeply after that initial stage. Is that what you're saying, or did I misstate?
Yeah, I mean, and you don't start a pitch deck with a model. The model's kind of at the end, So I have a Chris Volk rule that I don't like having a pitch deck that's much more than 20 slides, and they can't be too dense. And the first slide is going to kind of give you a highlight about what you're about to see and why you should be considering the investment. And the financial model is typically the second to last slide. So it's going to be, here's what we think we could do for you and why. And you're going to look at it and you're going to say, well, there are only like 10 variables or 5 variables in this business that really matter. And these guys know what they all are. And there's not that much, there's not that much complexity to getting there. So, people love simple businesses that they can wrap their heads around. They want to understand what the margins for error are. A lot of times people deliver models where they have nice returns and people get excited about them. I'm interested in nice returns, but I also like to know what's my downside. Like if you mess up, what's the worst thing that can happen?
Right.
And so I figured that we had a really good chance to make somebody north of 20% a year on their money, but when we were raising the money to start store. But if I really messed up, probably the returns would be something like 9%. And I figured 9% for downside, that's pretty good. I mean, that's about as good as the Russell 2000 stock index would do over a long period of time. So I think that from an upside downside risk ratio, it was pretty good, and we were able to attract investors. And when I started store, we raised $500 million to start it. So I had to go to investors to raise $500 million, which is and I didn't have to go to that many investors, so it was good.
Well, that's good. Yeah, it means you got a lot of high value. Was it mostly institutional, or was it?
Yeah, there's all institutional,
all
pension
institutional
funds and money managers. Yeah,
and then of course, Warren Buffett. So I wasn't going to let that get away from me here. So tell me what that discussion looked like.
Well, I first approached Warren Buffett in 2014. We were about to go public, but I wasn't sure that was the best thing to do. So, and I had some other ideas of what to do with the business. And so I sent him an email, and we had all these investment bankers that said that they knew him, but no one had his phone number and nobody had his email address. And so I went on to Berkshire's website and wanted to see how to find people at Berkshire Hathaway. And the general email box at the time at Berkshire Hathaway was berkshire@berkshire.com. And so I sent an email to berkshire@berkshire.com, introducing myself, saying I had an idea I'd like to talk to Mr. Buffett about. And lo and behold, probably 2 hours later, I get an email from Warren Buffett himself and asking for more detail. And so I put together this long email over the weekend and sent it out on a Saturday, but I had to run it by our investors because I was just a small investor, but we had big investors. So I had to make sure they were aware I was doing this. So, and they were all at this point pretty amused about this. So, and so we sent off, and I sent off an email to him on Saturday, and I figured I'd hear from him the following week. And at this point, Mr. Buffett's kind of in his he's in his 80s somewhere, like early 80s. And so anyway, I sent it off to him and he responded to me on Saturday. I mean, he read it on Saturday. I mean, I sent it to him. He read it to me read on Saturday. I thought I'd like hear from him in a week, in a week or something like that. No,
or not at all, maybe.
So I got it. I heard from him on a Saturday, and he introduced me to one of his portfolio managers, is a gentleman named Ted Wexler, who's one of the two guys that is there that does stock for him. And so Ted and I started to have conversations, and the long and short was that they actually didn't do what I wanted them to do, and they decided that they didn't have an interest in it, but they decided that they liked our business, and they started tracking our stock, and so our stock did pretty well through 2000. We went public in 14, and we did fine in 14, did fine in 15, did fine in 16. 17, our stock started to have a dip. And so and during this time, I'm talking to Ted Wexler probably once every 6 months or so. And as our stock's dipping in 17, I said, well, this is kind of interesting, because sometimes stocks fall and the business model's just fine, but they fall for just other reasons, and
Sure.
this is what Berkshire Hathaway does, this is what Warren Buffett does. They sort of hang around the hoop and they let stocks come to them in a way,
Yeah.
and so we were getting into a place where it was a large value play to buy us. And so I get this call from Ted Wexler wanting to buy 10% of the company. So we didn't like the stock price at all, but we issued them 10% of our company stock. And in doing that, our stock went up 12% the following day and just kept going up after that. So it was they were an excellent investor.
No, I mean that's yeah, it gave you credibility immediately to the world. That's awesome when those reports come out. People are going, "Oh, why is what's Warren doing this time?" So that was cool. So did you get to talk to Warren at all, or?
I've talked to him once or twice, but I didn't actually talk to him then. I just emailed with him. So
Right.
I guess I talked to him by email conversation. Um, Years earlier, I had gone to a charity golf event and I played like 1.5 holes with him. So
Oh yeah.
so I get to talk to him then. Yeah.
And if you don't mind me asking, unless it's private, was there something interesting about the conversation?
Well, I'll give you a story, and this is useful for today's investor because it may pertain to how they think about AI stocks or something. But um, this was in 1999 or 2000, kind of the same time I was writing that article that was the inception of the value equation. And so at the time, Warren Buffett owned no internet stocks. So in
Hmm.
the late 90s, the internet stocks started to come on strong, and if you were a broadband stock, you were coming on strong. So all these stocks were huge and heady, and I mean, and you had pets.com and you had grocer.com or whatever. I mean, you had all kinds of anything that was a .com stock that was doing amazingly well. And of course, none of these companies were really making any money. And
Right.
but there were tons and tons of IPOs, and a lot of investors wanted to know from Mr. Buffett, from Warren, why aren't you buying any stocks and this stuff? I mean, Berkshire Hathaway's avoided this sector completely, and so Warren Buffett, at the end of this golf event, gets up and on stage and he has two slides, and one slide is of every public airline that ever existed. And the other slide is of every public automobile manufacturer that had ever existed. And the reason he cited these two sectors is because, in his mind, they were the two most profoundly changing, altering sectors in the 20th century. And there were so many public car companies and public airlines that if you put them on slides, it was like stacks and stacks of companies. It was 8 point, you couldn't read them. I mean, there's so many of them. And he said, if you went long uh, these sectors, like if you just said, I'm going to buy a lot, every airline company and every auto company, he said you would have made zero money, I mean, none,
Right.
because you wouldn't have known who to pick, right? You would have, I mean, there would have been, maybe Delta would have been there or American Airlines or somebody that would have come out, TWA at the time or Pan Am, but you wouldn't have known who to pick. So you're not going to know who the winner is. But meanwhile, not only that, but you also miss the fact that these industries, even though they're tremendous industries, they're going to impact like the oil sector because you got to pump a lot of oil to like make the gas for the airplanes and the cars. They're going
Sure.
to impact the tourism industry. So you're going to have hotels everywhere because people are going to be flying or driving. So you're going to have motels, hotels, lots of restaurants, that kind of stuff. So that uh, these secular technology changes that happen, people tend to fall in love with them, like AI. They fall in love with them and anything that's AI. But the winners from AI are oftentimes going to be non-AI companies. They could be pharmaceutical companies. They could be other businesses that are going to benefit tremendously from AI. So it's going to be interesting to see.
Yeah, no, I mean for sure. It's we always talk about the picks and shovels on this podcast. Now everyone's starting to talk about it in terms of AI, what it is. But I didn't think about the picks and shovels are the ones like the infrastructure, the energy companies, some of the real estate companies are now. I mean, my God,
Mhm.
what they're buying up now. And but now to the reflection is who uses AI the best is what you're saying is some of the other companies we should be looking into.
Well, sure. And the other thing is that there are risks in AI too. So these data centers cost north of $1 billion a piece, and so the question is, are they always going to need to have data centers of this size, or are the chips going to change in terms of how efficient they are? And can you do AI more efficiently? Do you need as many chips to do the same AI? Or if they have quantum computing, how's that going to impact AI? So there's going to be lots of technological changes that are going to happen in the next decade that are going to be very impactful.
Yeah. So was Warren, was he drinking anything? Was he drinking his Coke or his Diet Coke or his
Oh,
eating his
when he was playing golf in 1999, he in 2000 he had a Coca-Cola golf bag with all the Coca-Cola golf clubs.
uh
He was drinking his Diet Coke. So yeah,
yeah. And was he hitting a good ball or does he play a lot of golf?
at the time he played some golf and he could hit a ball just fine. And what a I want to just say as what a terrific person he is. A nice. Uh, you're from Chicago, so solid Midwestern guy. Great ethic. Work ethic, and even all the people at the Omaha Country Club were calling him by his first name, no matter who they were, which says a lot about somebody.
Yeah, no, that's great. Sorry to make this all about Warren, but I don't, talk to too many people that have talked to Warren. So it's
Mm.
like, what was that? The Ocean's 11 or whatever it was.
Yeah, yeah,
Talking,
yeah.
you shook the hand and shook the hand of, yeah, Frank Sinatra. So,
Right.
uh, so, all right. So that's sort of falls in store capital. So now we sort of brushed by the fact that, while I, built a company and I sold it and I built another one, sold it, then a third one. Let's sort of slow it down a little bit so that our bright community here, they've already gained so much value and so much, knowledge in this short period of time we've been talking. So can you just briefly say, how does that go from the pitch deck to the, to the fundraising, to the, to the determining whether you're going to stay in the private market or exit out, how does that go? Just generally, we don't have to spend like 4 hours on it, but just, give our break community a little bit of a background, because I think it'll be more valuable when we start talking about your variables and everything else.
Yeah, sure. Well, I mean, it starts off with how much money you need. I mean, and the companies I've run have been all real estate based companies, and real estate's just expensive. I mean,
It is.
if you're going to be owning, I mean, we were owning everything from chain restaurant properties to retail stores to fitness clubs to veterinary clinics. We own a couple ski hills, and so all this stuff is expensive. I mean, it's hard to find a chain restaurant for under 2 million bucks, and you just and you move up from there, right? So it gets these pieces of real estate get expensive, and so when you're starting a company like this, very few of us could have that kind of money to start a business like that. And if we're trying to raise money, you're not going to raise money from friends and family to do it either, because even if you have them, I mean, it's too much money. So you're going to need money from really big people, which is you got to go to institutional guys. You're going to have to go to money managers. You're going to have to go to pension funds. You're going to have to go to people that have a lot of money to invest. And so that's what we did, and that's who our deck was targeted to when we were making our pitch deck. And one of the things that's important when you're starting a company is to then start to think about, well, how many people do I need to run this thing? So we'd created, we had a company that I joined in 1986, and we took it public in 1994, and sold it to GE Capital in 2001. And by the time I left, it had 250 people. We were in the real estate business. We did mortgages and leases. And when we were starting the second company, you're thinking, well, how can I run this better? I mean, we started that company a long time ago. What can we do to run this thing better? I mean, and run it with fewer people. What can we outsource? And so you start to design your company much differently. And I think it's useful if you're starting a business to just take a day or two and just with a blank sheet of paper, and to think about, how do I want to start it, and how many people do I need, and what kinds of people do I need to have to be able to do this. And so that's what we did, and we were able to. By the time we were running store, I was running more assets, probably double the assets of the first company with half the people, and you're just able to just do stuff a lot better and design the business a lot better. And it's part of that design process. It gets into some of the book, because the design process matters, because the goal here is to take the business that you're in, and the real estate business is a good business. It's not like the best business. I mean, the highest net worth people are in the technology businesses. I mean, if you look at the Forbes 400 list of richest Americans, there are not that many real estate guys there. There are a few, but not a huge number of them. And so real estate can be an okay business, but the thing is to take the business that you're in and that you've chosen, and to do the best you can with it, to take your business model and make it the best it can possibly be. And by doing that, then as long as you're going to be working your heart out to be in this business, you might as well make the most money you possibly can at it. And the way they make the most money you possibly can at it is to take the good customer products that you're delivering and wrap them into an amazing business model. And so that's what I want people to think about.
So yeah, sort of focusing in on what you're doing. You made your choice. Now make it the best,
Yeah, make it the best. Right.
Yeah.
I mean, you could be a restaurant operator, or you could be a veterinary clinic operator, or whatever. These are all businesses. And, it doesn't take, you look at the companies that are you look at the Forbes 400 list of richest Americans, and they all made their money in business, every single one of them. And if for the few of them that inherited their money, they inherited the money from somebody who did make the business.
Right.
And so it all comes from businesses. And these are obviously, because they're in the Forbes 400, these are some of the best businesses going. I mean, these are the best things going. But to be in the upper 1/10 of Americans, you probably have a net worth of something like 50 million bucks.
Mm-hmm.
Well, 50 million bucks isn't close to $1 billion, right? I mean, so it just shows you that,
nowhere near.
you don't have to be this good. Like you could be like a lot less good, and still be in the top 1/10 of 1% of Americans.
Yeah.
And if you want to be in the upper, you want 1/10 of, if you want to be in the 1% of Americans, the 1% of Americans starts off at like $13 million in net worth or so.
Yeah.
So, and most of the people that are in the 1% made their money in business too, and so, obviously they had a decent business, not as good as the guys making, in the Forbes 400, but it's okay. They're in the 1%. So,
Yeah.
So how do I get there? I'd like to see more people get there. So that's why I wrote the book.
So that's awesome. Yeah. It's like, and when you say, it's, get to the 1%, that's 13 million is a lot of money, but it's kind of, you're right. If you're doing what you can and doing the best you can and what your business is, you can get there. So now you give them a guideline. So before we get into the nitty gritty here of your book, and I do want to get there, but I'm having so much fun talking about this other stuff, but let's get, we'll have fun talking about that. One of my favorite lines was started with, is on page 12. It said, most businesses start with an idea, which usually takes the form of a solution to a problem. The key question is how to build a profitable business model around the idea. So is that what we were just talking about? Is there more to the story?
No, that's it. And as you get into one of my favorite stories in the book, there are a lot of stories in the book, but early on, I talk about Larry Page and Sergey Brin, who started Google.
Yeah.
And these guys started Google, which is basically a search engine. At the time they started Google, they weren't the first search engine out there. There were other search engines, but the search engines had a tendency to give you answers that they wanted, and they restricted how you looked at stuff. So if you were working on America Online, for example, which was early on, you had categories that you could go, and they were preset. So you didn't have a lot of flexibility. You couldn't search for just anything you wanted to. And when Google came out, they had this just empty box in the middle of your screen, and then you could type whatever you want to in this box. And they had this search algorithm, and they could find whatever you wanted to, and so that was kind of the solution to the problem. They had people out there that wanted to find stuff. And so, Larry and Sergey created a solution to the problem. But the question was, like, how do you turn that solution into a business model? I mean, like, how do you monetize it? Like, why would people pay for this? To do this. And so, it took them like, I think 1 to 2 years and and I don't think they were the people that invented the idea, but they were presented with the idea of creating AdWords. I mean, selling search words to people that would be wanting to give you advertisements based upon the words that you were searching for, and and in doing that, they became billionaires within 1 or 2 years of that happening.
Wow.
They had this light bulb moment in terms of how to wrap this product that they had around this great, revenue generating model. And once that happened, Google had just launched. And it created wealth out of thin air and overnight. It was just a gusher of wealth.
Yeah.
And there were lots of technology companies at the time, Microsoft and others that were out there. They understood what internet searches were. They just didn't know that you could make money at this. I didn't know it could be a good business, right?
Yeah.
And it turns out it could be like a flat, great business. Just an amazing business. And so that's kind of like that shows the importance of how business models get designed in a nutshell. But most of our designs aren't light bulb moments quite that good.
Right. Yeah.
So but they're there. You're designing, you're taking it, this idea you have, and then you're saying, how do I execute this the best possible way I can?
Yeah, it's fun. It's so funny. It's like this light bulb moments is a very big passion project of mine, and now that it's gaining traction, we getting these incredible guests. It's the same concept. Is like I'm not thinking about monetization because I think it's going to ruin it. And I've got a couple venture guys already talk to me. Hey, how can we make money on this? That blah blah blah. And it's funny. Is like as soon as I start thinking that way, then it changes the dynamic. But again, this wasn't my. So is there a good in having passion projects that aren't trying to be monetized, or should you always, as you're a business mind, try to monetize what you're doing?
Well, yes, there is good in having passion projects that don't have to be monetized. I'm telling you that because that's what I'm doing right this second with you. Uh, I'm not doing this because I want to be a public speaker and get paid to come speak with people. I'm not doing this because I'm have my own podcast that's competing with your podcast.
Yeah.
I'm doing this because I just think that people should have a better understanding of the fundamentals behind how businesses succeed financially and create wealth for their investors. And how does all this work? In today's world, you get all kinds of discussions about how do businesses, who do they benefit and stuff. And there's a chicken and egg here, which is that when you're raising money you're on Shark Tank and you're with the guys at Shark Tank, or you're raising money from investors. They want to know what's in it for them, just like any customer wants to know what's in it for me. They got the
Yeah.
WIIFM thing on
Yeah.
their
With them.
forehead, right?
Yeah.
Yeah, with them,
I,
and so you can't really start a company without flashing some good shareholder returns or the possibility of shareholder returns. And if you can deliver that stuff, the goal is to deliver shareholder returns that are more than what the market wants. So like if you think about the stock market, stock market over a long period of time has a shareholder return of about 10, maybe 9, so let's say kind of in that range, over a long
sure.
period of time, with, by the way, some years like losing money, some years making money. As Warren Buffett likes to say, he doesn't really care about the volatility. He just wants to make the 9 or the 10 or the 15, right? He's
Yeah.
looking at the returns,
Yeah.
so because he's a long-term investor, which is also very important. But anyway, so the long-term stock market's like a 10, give or take. And so if you can make, my personal view was, if you can make better than the 10, then you're likely to have a company that's worth more than the cost of its parts. But if you can't make more than a 10, if you're a public stock company and you can't do more than a 10 or a 9, then it's likely that you're not going to really you're deliver a 9 or 10. That's great, but you're not going to create a company that's worth more than the sum of its parts. Your chances of being on the Forbes 400 are zero.
That's
And your
right.
chances of being in the upper 1/10 of 1% probably aren't that good either. You got a public company making 9 or 10, but it's just worth what it costs to create. And most companies in America are, if you think about most entrepreneurs in America, they're creating companies that are kind of vehicles for self-employment. They get to be their own boss. They don't have to answer to anybody else. That's great. But if they had to turn around and sell their business, they wouldn't really be able to get, a huge paycheck out of it. They might get their money out of it or whatever, but they wouldn't get, any huge gains on it. And so the goal, the way you make gains is by making returns that are more than what people expect, and if you could do that, then you can, it's like alchemy. It's like creating gold out of from lead. It's creating money out of thin air. I mean, if you could do that, you can create huge amounts of wealth. And by the way, in a very short period of time. So you look at guys like Larry and Sergey, but there are others in the billionaire class that have become worth billions in really a matter of just 1 or 2, 3 years. So.
Yeah. All right. So we've tortured our break community enough. Let's get into some of the nuts and bolts of the value equation so our break community can learn about how to do this.
Well, I'll give the 6 variables, but I'm not going to do the equation for you, because if I do that, and some of these variables need descriptions too, by the way. So like it's not like a defined term where everybody knows what this is, but but I'll give it to you, and then I'm not going to do the math because I'm going to just invite you to go to the book or go to my website, and look at it. And I've got video series going out too. That's going to help you too.
Oh, that's awesome. When's that start?
That started October 1. So we did our first video October 1, and we got another one October 15th that just did. We'll have one November 1. So there'll be 25 of them that'll go out over the next year.
Oh, I'm so excited. I'm so excited about that, actually.
So anyway, it'll be the value equation and then some, but also the book is always useful as well. So it's, I'm doing anything I can to help anybody who's got an entrepreneurial streak. Or, by the way, if maybe you just want to invest in companies like this kind of understanding all this can make you a better investor. If you're understanding it, if you're figuring out what kind of company you want to work for, working for a company that's got a better business model is always better than working for a company that doesn't have a good business model, because companies that have better business models will create, they tend to pay their people more. They tend to have more opportunities. And so if you kind of understand what the dynamics are, that's great. All right, you want to start?
Yeah. Well, I mean, let's start with a variable. I mean, come on.
Let's start with a variable. I'm holding out for you. So the first variable is like, like, light bulb moment. It's sales. Okay. And sales is probably the one virtually self-explanatory variable in the whole thing. I mean, it is someone. I started off in banking, as someone once ever said to me, no company ever went out of business because they had too many sales. So,
right.
And so, sales is the number one variable. It's the top line. The second variable is what I call business investment.
Can I go back to sales for just a second?
Sure.
Can you just, because everybody, and it took me a while to figure this out too, sales, versus marketing. How do you, and we won't do this every one, but how would you define sales to our break community can sort of tie in, because it's the key to everything.
Okay. Well, sales is just revenues. So the model is a financial model. So when I'm thinking about sales, this is not a sales course, and this is not like Dale Carnegie telling you how to sell, or
right.
I mean, there are courses for that, but this book is going to get you kind of the financial essence of like what it takes. But sales, if you break it down, is basically the number of customers you got, times the number of stuff they buy, number of orders they make, and the average price per order, right? I mean, so if you multiply all those 3 things, that's pops up to the line as revenue. So whether you're getting more customers, or whether you're getting each customer to buy more stuff, or you're raising the price on all that stuff goes into sales. And these are things that anybody who's running a business has a chance to change any of that stuff, right? I mean, and one of the things that absolutely separates the Forbes 400 group from the rest of us is that they are dealing with global markets. I mean, most of these companies in the Forbes 400 are, they have offices in multiple countries, if not the world, right? I mean, so they figured out how to do something really good and sell it not just to 1 or 2 people, but to millions of people, and do it around the world. And so, but sales is definitely important, and it's the thing that starts, that it's the essence of the beginning of a business. And all businesses, like I say, they're there to solve problems, and the problem could be like, what do I have for lunch? So, how do I make a sandwich, right?
Yeah.
Or how do I send a rocket to outer space? Or how do I put my pet up for care? I need to have somebody take care of my dog. Um, and as a business, you're there to solve a problem for somebody, and you're going to charge for that, and so you're going to figure out how much it is you can charge, and that's sales, and you want to get as many repeat customers as you possibly can, because the best customer you got is the one you already have, and you're going to figure out how much more you can sell them. But anyway, so sales is number one. And
Thank you.
in right behind that is what's called business investment. And business investment is a defined term, but it's just basically the amount of money you need to fund with equity or debt. So it's kind of like or leases, So I actually like to refer I don't like calling things debt. I like calling it OPM, or other people's money, and I do that in the book. And the reason I do that is because um, when you're needing money from people and you're needing to finance stuff, it may not be borrowing money. You may get stuff from you may be able to lease equipment instead of owning it. And in my career, I was in the business of leasing people real estate. So I became their landlord as opposed to a banker. And they had a choice of owning or renting real estate. And so we provide all the money they needed to rent the real estate instead. And
Mm.
so it was a kind of a capital decision. And so business investment is let's say you have a business investment of $1 million. And if you have OPM of $800,000, then the equity has to be 200,000. So basically equity and OPM equals total business investment. And so, and the thing about business investment is, the less it is, the better you are. When you're trying to create a company, you just want to do it with less. And if you could do it with less, then you need less OPM and you need less equity. And so if you can do all things being equal, if I got the same sales but less investment, I'm just better off. So one of the things you're trying to do when you're creating the value equation is to have these variables that all impact shareholder returns, and business investment absolutely does, because you want to make it as efficient as you possibly can.
Nice. So yeah, no, I that was explained very well, and I love OPM, other people's money, and until people understand, leverage and using other people's money to make money, that's a huge light bulb moment, and I think people always think they got to use their own money. So very valuable. All right, what's number three, sir?
So number three is operating profit margin, which is basically, after you sell something, and after you got all the expenses that are associated with that, how much cash flows through before you got to pay for any rent expense or OPM, before you pay the OPM money or anything like that? What's there to pay the OPM money? So what kind of margin do you have? And we're talking about cash here. So we're not talking, don't think about, I'm a finance guy, so I don't want to clutter it up with non-cash accounting stuff like depreciation or anything. So I got my sales, that's easy. I got my expenses to run a business, that I'm paying for, my staff, my product costs, my rent for my space or whatever it is. But like, what's left over to pay for the OPM, and so that's operating margin. And so you want to make the operating profit margin as high as you possibly can. So you want your business investment to be as low as you can, but you want your operating profit margin to be as high as you can. And so you could do that by several things. You could do that by having higher prices on your product. So that's going to make your margin better. So part of it's a pricing thing. You can make it by cutting costs and having your costs as low as possible. And as you're running a business, you want to do both those things. I mean, you want to make sure that you're pricing your product right. And you also want to make sure, you don't want to give away your product, right? And you want to make sure that your operating profit margin reflects very efficient operating costs. So you want to run it as efficiently as you can. And like I said, when, we were earlier on in this program, our last company, I was running the company with like half the employees that I had in the first company, because we just figured out how to do more with less. And that's always a smart thing.
So yeah, I mean, that's really a big light bulb moment is the concept of you learn from the first company into the second company. You've said that a couple of times, is that's an important factor. But are you trying different things to get to this point? I mean, is it trial and error? Is it a methodical? Is it an educated decision when you decide, hey, I need to cut costs here or I need to raise the price? How do you get to that point?
Yeah, well, for me, I got really lucky because you know, took three companies public on the New York Stock Exchange, and I started two of them from scratch, and every one of them was in the same business. So basically, I got to do the same thing over and over again, but I got to just do it better, Um, and I get to look at what I did before, and I got to do it better.
Nice.
And uh, and so the first company, I think, when the first company was done, it was so new that a lot of us didn't know how we were supposed to be organized. I mean, nobody had ever had a company like this. I mean, hey, you couldn't look at somebody else's company and say, "What's the blueprint for doing this?" Right? I mean, um,
Yeah.
like if you're looking at a commercial bank in the U.S., there's certain companies in the U.S. where you look at them and say, "Well, this is how other people run it." What do I think of that? But here there wasn't any model I could look at to say, what's the best way to run this business. And so we kind of meandered a little bit. I mean, we zigged and zagged, and we sort of tried to do the best we could. And by the time I was doing the second company, I was able to sit back and say, there are things that if I could just do it over again and had a clear, a blank sheet of paper and a pencil, I would just do them differently. And so uh, and we did. And so I think if you're starting off with a company and you have some other models that you can start off with, that's great. If you don't, you just try the best you can. But over time, you're going to have to like reassess all this stuff. Like, I mean, there's six variables. You got to reassess every one of the six variables all the time. So.
So you're always constantly, it's a constant process in your head. It's like, what are we doing? Is it the right way?
Totally.
Yeah.
Totally. Because your goal is to make the highest possible return given the business you're in. You want to do the best possible return you could possibly do. And so you're thinking, what can I do to make this better? And because the better it is, then the more money you're going to make, but the more you're going to be worth personally as the leader of the business. But then all the people that are working for you, maybe they got stock too. So then they're going to be worth more and you're going to have more employees for your staff and other stakeholders, and your shareholders are going to be happy.
Got it. So I think there's a whole discussion, a different podcast, different day about change management and changing midstream and all the other stuff. I'm assuming with big
Oh yeah,
companies is always change. And
very difficult too.
yeah,
Um, and so you want to do variable four?
yeah, let's go.
Okay, so variable four is the percentage of the company you got to fund with other people's money. So you got leases, you got loans, you could have preferred stock, you could have convertible preferred stock. I mean, there are all kinds of forms of OPM, and you can like be pretty creative. I mean, if you're in finance, you start to get pretty creative about the kinds of OPM that exist. But uh, an OPM is basically, these are not equity holders; these are people that have they're effectively kind of lenders to the business or financiers to the business. And so if you are wanting to get a copy machine and you don't want to own it, you want to rent it, then there's a leasing company. That leasing company is putting up the money for that copying machine. In my case, I'm renting the real estate. So if you were in the fast food restaurant business and you wanted to open up a location, maybe I'd buy the whole real estate for you and you just rent it from me. Or you could go to a bank and borrow the money. So you could go see, what can I borrow the money from for a bank? What's the bank going to lend me for this location? So you have all kinds of choices about how you finance stuff, and financing can get super creative. When you're thinking about OPM, one of my observations about OPM is that a lot of times people in business today don't really fully understand what can be done with OPM. And so sometimes when people are selling their companies, they don't ask enough for them. They sell them too cheaply because they have them financed inefficiently. And they just assume that the person buying the company is going to finance it the same way, right? But if the guy buying the company finances a totally different way, then they might be able to buy it with nothing down. And I've seen people buy great businesses with almost no cash down. So
Yeah.
it's so the amount of OPM is number four. It's a very important piece of it, because the more OPM you have and the less equity you got, then the higher the equity return, all things being equal, right? I mean, because the inverse of OPM is equity. So, I'm going to first think about maximizing OPM, and I'm going to not really, the idea is not necessarily to push the envelope on OPM, because you want to make sure you have a good margin for error. So people think of leverage as being like risky and stuff. Every company has leverage. I mean, every good company uses some level of debt for the most part. Um, and but you just want to make sure that you have like margin for error, that you're okay. And so you want to have a prudent OPM stack, but you want to figure out, what can I do with OPM? And that's the first thing you want to do. And then you back into what your equity need is. And when you back into the equity need, if it's small enough, maybe you go to friends and family, or you're going to like smaller investors, family offices. If your OPM need is huge, like my OPM need was huge, and if your equity need is huge, like my equity need was huge, then you got to go to institutional investors. So trying to figure out the OPM equity mix is really not only helpful in determining what your return is going to be, because less equity is going to generate higher returns, all things being equal. But knowing your mix is going to determine where you go to for money.
Yeah, yeah. So it's all a balancing act, and if you need somebody that's always got their eye on the ball for this and analyzing this, because you can, especially when you have to refinance and recapitalize, those are all techniques which we can talk about another day. Let's get to episode 5 and 6, or episode. Listen to me.
Yeah, variable five and
Variable
six.
five
So
and six.
so the fifth variable is just the cost of the OPM. So you got, what's your OPM mix now? Your fifth variable is like, what's the cost of this thing? And obviously you want, cheap OPM is better than expensive OPM. But you also got to be really super careful about how flexible your OPM is. So if you're leasing or you're borrowing money, you want it to be super flexible. Sometimes people have a tendency to go for the cheap money as opposed to going for the most flexible money. But the
Mm,
flexible money can really matter. So if you can really run your business well, and you don't have to ask for permission to do stuff, if you can prepay loans or modify leases in ways that make it so it's easier for you to run your business, that can be a huge win. So the cost of OPM is uh, not just whether it's cheap or expensive. It's also how flexible it is. And um, OPM, even if it's expensive, tends to be cheaper than equity. So equity is by its nature, since equity is taking all the risk. I mean, the OPM is going to get paid back before the equity gets paid back. So the equity is going to want a higher rate of return. When we were raising our money from Store and for Spirit, our company prior to that, probably the minimum equity return our investors wanted was, let's say, 15% a year. They were really looking for something kind of in the 20 range. So it's, the OPM is going to be less expensive than any of that.
sure.
A longtime business partner of mine, said the if you can afford availability of capital is everything, and if you can afford it, pay for it, and don't
Mm,
complain. And so anyway, cost of OPM is variable number 5, um, and just to wrap it up, the final variable is what I call maintenance capex. And maintenance capex is basically sort of what it sounds like. It's, what does it cost every year? How much money do I have to spend every year to keep up this business so that customers are going to keep coming in through the door? So I'm in the restaurant business. I got to replace French fryers. I got to replace I got to redo the outside of the building, or I got to make things pretty. I've got to fix the HVAC units, buy a new one, something like that. I mean, that's maintenance capex. But maintenance capex is not just sort of like the annual stuff too. It's especially if you have customer facing businesses, it's like maybe every 5 to 10 years you're going to do a complete facelift. You're in the hotel business. You want to do a whole facelift on your hotel and change the lobby, do some real construction to this. And people always say it's a one-time expense or something like that. It's not a one-time expense. It's basically part and parcel of the business they're in. I mean, they're in a consumer-facing business, whether it's in restaurants or hotels or retail. I mean, you're going to have to spend every 5 years or so some money on this stuff, and so you want to make sure you include that. And the last thing I will mention is that, you know, as companies get bigger, oftentimes like they'll make mistakes, you know. So for example, Walmart has closed down lots of locations. I mean, they've closed down Sam's Clubs and whatnot. They've relocated stores. All this stuff has a cost to it. Google, which is a company that's grown through acquisition, has bought company after company, and not all of them really work out. I mean, sometimes you've got companies that get sold off, they get bought one day, you know, for a few billion, the next minute they're sold off for something that's a lot less than that. And so a lot of times people in business like to tell you this is a non-recurring cost or you should ignore that. And that's not true. I mean, from a finance perspective, you know, they just lit some money on fire, and lighting money on fire is okay. But if you're going to do that, you got to put somewhere in your model. And so that place for me is that sixth variable, which is the maintenance CapEx variable. And I tend to shove some other stuff in there that
Catch
includes that
all.
sort of, you know, lighting money on fire type stuff, you know.
Yeah.
So,
Because it's
and
always going to happen, right? It's always going to happen.
yeah, and you want to keep obviously that number as low as possible. And you know, so some of these numbers you want to max, some of these numbers you want to keep low. I always like to say it's not high or low. You want to optimize. You know, this whole thing is, you know, like you don't want to maximize shareholder returns, because if you maximize shareholder returns, maybe you can't have as big a company. You're charging too much money. Maybe you should have like slightly less shareholder returns, but more of it, you know. I mean, so you want to optimize it because you're trying to create as much value as you possibly can.
All right. Well, that was the best of all, though, what you just said. As a maximizer, as my thing coming in, when my precursor to my podcast is I like to maximize. But you're right, optimizing and making sure everything good, that helps with downside risk. It helps with the bad times. If you're evening it out, that's awesome. I love that light bulb moment. So I know we're running just about an hour. Do you have time for a couple more questions before we wrap, or you got to
I do.
go? All
Yeah.
right, cool.
No, I got
So
time.
let's shift a little bit. That was so awesome. I appreciate the knowledge base, and the cool thing is that's probably the first like eighth of the book, and then you're going to get more. I encourage people to read it because it was hard. I had a busy week this week. I didn't get to pick it up and keep going with it, but it's worthwhile seeing how this applies just beyond the theory that we just discussed. The math is pretty cool. All right, so there's been a huge drag the last couple of years, and I know it's starting to loosen up a little bit, but with the M&A market and private markets not getting into the IPO, and a lot of maybe public companies going private, is it starting to loosen up a little bit, or is this uncertainty in the market, the tariffs, et cetera, is it causing us to have a little bit of a down market on the IPO side?
Yeah, I think there's a lot happening. I mean, I do think that uncertainty on tariffs is never a good thing, right? So we live in a world where there's political risk today. I mean, you're in business. Like, I mean, um, we had a customer of ours. We went to the store, public company, large company that is in the retail business, and they bought a lot of their goods from Vietnam and China and elsewhere. And in in the first Trump administration, there were some tariffs that were put on, and it was, so you're a company, you've got a supply chain, you're expecting it's to be predictable. And when you put in tariffs, you've now introduced a kind of an element of unpredictability to your whole business. You've like, we've been talking about how do you create a business model and how do you design a company, right? And you've been sitting there working like crazy to design your business, and then all of a sudden you've got a changing tariff environment, and it's wrecking your
Wham!
design by the second, and you're trying to figure out how do I deal with this. And um, so yeah, I mean, I think that's not good. I think it's not good for employment. It's not good for companies wanting to unleash stuff and say, I want to, go ahead and move forward with projects. I think it's gonna have a definite impact on the economy overall. Um, uh, at the same time, there are about 3,000 give or take public companies out there, and that's a low. I mean, there used to be like 5,000-6,000 public companies, twice
Yep.
that. There's 3,000 give or take today, and not only that, but if you're looking at the S&P 500, 40% of the value is something in like 20 companies, right?
It's
So,
crazy.
it's crazy, right? So you have a lot of top end value concentration and all of this stuff. Meanwhile, the number of companies owned by private equity firms is enormous. I mean, it's just a staggering number of companies that are owned privately. And so there was an article in the Wall Street Journal not too long ago, or an editorial that was suggesting that some of this is due to just the difficulty of being public. I mean, all the hoops you have to run through to be a public company in this country. And I think there's some truth to that. But I also think that there is some truth to the notion that uh, a lot of private equity firms like having these companies private. I mean, if you look at the Forbes 400, and you've got 25% of the guys there are in the asset management business, which includes private equity and whatnot. This is a great business, right? And so they don't want to necessarily reduce the number of companies that are not private. I mean, they want to really promote more private companies that are out there. So there's a desire on the part of a lot of money management firms, I think, to keep companies private. And so I think that's kind of where we're at. We've got this push-pull thing going on, and there's a lot of incentive for keeping companies private and not listing them public today.
Yeah, no, it's pretty interesting. I think there's more a couple more exits coming. There's some big ones, and obviously, little disruption in the private credit market here for a little while, but it's coming back pretty strong again. So anyway, so that's great. So the last thing I want to talk about and actually before I forget, I have a group that I travel around the United States with. It's called Consortium, and I think this would be some very good. I know you said you weren't going to be a public speaker or whatever, but perhaps when it comes around, we bounce around from state to state. Maybe you could speak to us about what you're talking about. I think it would be very well received. It's mostly family office, private equity, some politicians in there, some lobbyists, and a little bit of institutional stuff. So if we'll talk about that offline.
I'd be happy to.
All right. So the last thing before we wrap is that there's this obstacle sort of thing and things that happen in business that really like you said, the tariff with that guy from, operating from Vietnam and tariffs coming in. So do you have any like quick stories about things that have happened in your world and how you've recovered from them? Because we all fall into the trap. I mean, I get slapped in the face occasionally, and I got to figure out my way out. So, anything that you could share with our Bright community?
Gosh, you're hitting me on the you're hitting me out of the blue. So I got to think about this. But I would say that when we were starting our first company, our first company was created through a lot of different partnerships. We raised money through Wall Street. We were at EF Hutton at the time. If anybody in your audience is still there that remembers EF Hutton. But anyway, we basically had all these partnerships that were created from EF Hutton, and we merged 11 partnerships together with a management company to do this stuff. And we were proceeding to do it, and moving right forward with it, and it was good. So anyway, I had there was a group of people in California that made a living selling buying and selling partnership units on a secondary market. They were just making a spread on this. So basically, we might have some investors, and these guys were like buying their units out and then selling to somebody else, and making profit on the way. And they didn't want us to go public, because if we went public, it was going to create a problem for them, because they would be, be one less company that would be there for them to buy and sell stuff with. So, and there had been some mergers or some roll-ups of partnerships that had been done very badly. So the next thing we know, we have a bill in Washington, D.C. that's, and this is getting to political risks for like tariffs today, but this is a bill in Washington, D.C., where they were going to put in place restrictions on allowing companies to merge all their partnerships or assets and listing them onto a public exchange. And there was a threat that we were going to have this be disallowed. And I remember all of a sudden you're faced with this. You've been working on this project for a year, and you're faced with this problem where the government's going to just take away your ability to do something. And so I'm calling up Congress people from my desk in Arizona. I didn't really want to use a lobbyist, because if you use a lobbyist, I mean, I think Congress people like to talk to the people that are really hurt, I mean, so I was fixing to be really hurt, and so I'm calling up congressmen and saying, like, this really matters, and you're doing it, and it's wrong, and it's going to hurt our investors, and it's not the wisest thing to do. And finally, as I'm doing all this stuff, we're going to Washington D.C. And we're pounding the marble in D.C., talking to all kinds of Congress people and Senate aides and stuff, and somebody from a Wall Street house, I won't name the house, but it doesn't exist anymore, came to us and said, even if they pass this, we're gonna figure out a way around it, because we're going to tender for the units, and so what that meant was that we would go to our investors, our existing investors, and we would basically give them an offer to buy them out. But at the same time we were giving them the offer to buy them out, we were going to raise money from a new group of people to tell them this is a great deal to come in, which is kind of a bizarre thing because you're on both sides of the equation. On the one hand, I'm telling investors, like, this is a sweet deal, you should take it. And I'm going to new investors and saying, this is a sweet deal, you should take it. And I just didn't like being in that kind of conflict of interest thing. I thought that, we should give our existing investors the chance to go into this public company. And if they didn't like it, by the way, they could sell the stock later on. And so anyway, I went to somebody in DC, and I said, if you pass this bill, we're going to really do something that's not right by our investors. I mean, because we've got advice from all kinds of Wall Street houses that we could do it this way. And my language was a lot more colorful than what I just said. And the congressman looked at me, and the blood drained from his face. And with that, he basically let me and our general counsel, outside general counsel, write the legislation, and so we were able to change the bill in a way that allowed us to do what we wanted to do, and we got our company listed on the New York Stock Exchange. So it's just, it's one of those things that put a roadblock in front of us for about 6 months, but we got through it.
See, now aren't you glad I asked that question? That was a great story. I like to put my guests on the spot to torture them a little bit. So thank you for performing so well. And that's what'd you say?
It was fun.
Yeah, no, that's good. I mean, it's a good story. You got to be persistent. You got to, take these problems head on. You can't just, give up and, put up the white flag. I mean, it's important to your investors, important to you. You gotta do everything you can. So that was a funny thing you said about the congressman. That's when I listened. I've been getting in this consortium group. I get to talk to some of these people, and they're anxious to hear what the business people hear what they're saying about what's going on, because they don't hear any of it. Until you're talking to them about it, they don't know.
No, and I'll tell you what, like, when you write a book like The Value Equation and you think about this stuff, what you get down to is you don't want our Congress to mess with business models, right? I mean, so for example, there was a tax put on in the last administration, and this is not a partisan comment, so don't take it that way. But there was a tax on stock buybacks. Stock buybacks are like, when I'm in a company, I could dividend money out to you, or I could buy in stock. Either way, I have less cash. Right? The company has less cash.
Yeah.
And the stock buyback is really no better or worse. So what you want to do, and from my perspective as a business person, I'm okay about discussing tax policy or whatever, but just don't mess with business models. Don't tell me this is better than that. Don't try to direct me in terms of the most efficient ways for me to run my business. I mean, I've got 6 variables I can play with. Let me play with my variables, and don't mess with it. And that's what I would like to keep politicians around, away from this stuff. So.
Got it. I'm sending that piece to a couple of my congressmen. I love it. That's great. So
don't mess with my 6 variables.
Yeah, it's like, don't touch those variables. I love it. It's very a defensive posture.
Mm-hmm.
All right, well, cool. I've got maybe like 400 more questions, but I know our break community knows that we try to keep these at less than an hour and a half. So, but I'd love to have you on again if you'd be willing to do it. We got a lot more to talk about.
So I'd be glad to. So you just tell me when you want to do it, and then if you want me to talk to your group too, I'd be happy to do that.
That's great. Any other final thoughts for our Bright community before we go to the wrap?
No, I mean, I think that one thing I would say is that as you're thinking about your what you want to do in life, I mean, if you want to run a company, I mean, I start thinking about that early on. I mean, the first day I walked into my job at a bank, I'm going, what's it take to run this place?
Yeah.
As a trainee, right? So,
Yeah.
because you either make things happen or things will happen to you. So I've been trying to live my life in a way that can make things happen, and I'm hoping that I can help other people make things happen.
That's great. And thanks for, giving of yourself. I love the video and the book, and everyone should get your book. And by the way, how do people reach out to you? How do they get your book? How do they communicate with you and so forth?
Sure. So I'm on LinkedIn, of course, as I'm sure you are and everybody else is. You can also find me at Christopher H. Volk, V as in Victor, OLK.com. And you'll be you'll be able to get my videos and you can contact me through that. So
Cool. And we'll put all of that in the show notes. So our Bright community who's not writing all this stuff down, you'll be able to see it. So I'm going to go into a quick wrap, about 30 seconds, and I'll be back to you to say goodbye. Christopher, is that all right?
Yeah, fine.
All right.
Thank you.
All right. All right. Well, I as promised, lots and lots of light bulb moments, and I'm not going to do justice to all of them here. So listen to this podcast a couple times and read the book. It's very valuable. So first light bulb moment, fantastic. Schoolhouse Rock. It binds everybody in society that at least listens to it. And if your kids or your grandkids have not listened to it, just it's all on the internet. Go grab it. They'll learn a lot, and it's a great thing. I'm still talking about it 50 years after I first saw it. Take advantage of that time period, and I'd love that idea of the COVID break there. I got all these things going. I can't get out of my house, so guess what? Be like Christopher here. Write a book. Help other people. Think about it. Put your thoughts away. We talk about that all the time. Is sabbaticals and time away. It gives you time to think and then add value to yourself and others. When you're raising money, short pitch decks are the way to go. Keep the financials simple so everybody can understand them, and then show how that applicable financing will get them into your good business model, which is on page 18. Always ask. You never know. You email the info at Berkshire Hathaway, and all of a sudden you're hanging out and getting Warren Buffett interested in your product. Fantastic. Take your business that you've chosen. Take it. You've spent your time, your life. You've been investing time into it, and make it the best. If you try to do too many things and too many businesses, focus on the one you've chosen. Here's my favorite: create money out of thin air. If you want to have a 10% return, go ahead and invest in the S&P. You'll probably hit that. But if you want to make some great money and great value above that, where really you're making money out of thin air, do it through business. This is how that's not everybody, but most people that have succeeded and are at that 0.01%, 0.001% or whatever it is, they did it through business. And of course, my light bulb moment of all, I know I'm saying I'm a maximizer, but maybe I'm doing it the wrong way. Don't always maximize, optimize. Love that. And we'll see everyone next week for another positive day of illuminating thoughts and light bulb moments. Christopher, thanks so much for coming on. I hope you enjoyed this podcast, and hope you found it valuable, because I certainly did.
Well, Phil, thank you very much for having me, and I enjoyed it a lot.
All right, we'll see you soon.
Thanks for tuning in to Light Bulb Moments. If you enjoyed the show, please take a moment to rate and review us on Apple Podcasts. It really helps us out. Don't forget to check the show notes for important links and contact information, or visit lbmpodcast.com. Until next time, keep embracing those light bulb moments.